Hi guys. So I want to finish up Chapter 3, Homework 2. We had worked through the first 6 questions, and we were almost finished with question 7 when we ran out of time. So let me make sure this thing is on properly. Yes, I can see myself. Dr. E's wearing red today. So we will, let's go back to the beginning of question 7. What are the formulas for the 8 primary leverage ratios? Ratios that are measuring how much leverage, how much borrowing a company has taken on. So the first formula is total liabilities divided by total assets. Okay? What percentage of our assets have been financed with debt, long-term and short-term? We borrowed money to buy assets. How have we financed our assets? How much of it is being financed with debt? Then we're going to compare total non-current liabilities. Okay? So once again, so we're in our liability section, and this is long-term liabilities divided by total owner's equity. So we're comparing the amount of long-term debt to the amount of equity we have. And remember, equity is contributed capital and retained earnings. Okay? So what percentage of our assets have been financed, once again, with equity and with debt? How much equity do we have compared to the amount of debt that we have? Then we have total non-current, let's write it this way, total non-current liabilities divided by total owner's equity plus total non-current liabilities. This is sometimes called debt as a percentage of total capital. Sometimes this formula or ratio, total non-current liabilities divided by total owner's equity plus total non-current liabilities, sometimes this is referred to as debt as a percentage of total capital. Then we come to average total assets divided by average total equity. This is sometimes called the equity turnover ratio or the equity multiplier. This ratio right here. Now, I want to make sure that you're clear on this. When I say average, I'm talking about beginning of the year total assets plus end of the year total assets divided by 2. The average for the year. Okay? You do that for assets and you do that for equity. Okay? My phone is ringing and I have a business that I run. So let me check and see who that is calling me. So we're going to pause for just one quick moment and see who that was that called me. Ah, it was my daughter. I'll have to call her back in just a minute. I'm going to put you guys first. All right. I will call her back. So, we average our assets in the numerator, and we average our equity in the denominator. That's for the year, and we get our equity multiplier, equity turnover. Okay, now I'm going to erase this to make more room. So be sure you got these definitions. Here we go. All right, so now we've got times interest earned. Another way of looking at leverage and how it affects our company. And that is EBIT divided by interest expense. So these two items are the first two items that come from the income statement. What are we trying to do here? We're trying to determine how much operating profit we have that is available to pay our interest expense. Okay? So the higher this is relative or compared to this, the more liquid a company is. All right, now we have debt service coverage. And debt service coverage is EBITDA or NOPAT divided by your debt payment. Okay? Your debt payment or debt service. Now, debt service equals the interest and any principal that will be paid. That's what debt service is. So, there are these types of loans that are called amortized loans. Amortized level pay loans. Like a house payment. So, you got a 30-year mortgage. That's the standard length of time that banks will loan on a home loan. And let's say you borrow $200,000 at 4% for 30 years, payable monthly. Just that's what your parents have done. That's what you will do, okay? And let's say your payment is $1,000 a month, okay? What does that $1,000 consist of? Well, part of it is interest. Let's say $300 a month is interest on what you borrowed, which is the $200,000, and that means $700 is principal. That means each month, every time you pay $1,000, 300 of it is interest that goes to the bank, and 700 is interest that goes to the principal that goes to the bank that reduces your $200,000. So what do you owe at the end of 30 years? What do you owe the bank? And the answer is nothing. You've paid the loan off over time. So what this does, this debt service coverage, EBITDA or NOPAT, which is cash flow, divided by debt service, what this does, it tells the user of this ratio the ability that a firm has to make its debt service payments. And that's really important. Okay? All right. All right, next, fixed obligation coverage. All right, we talked about this in the video, so I don't want to be too repetitive. It's EBITDA divided by all fixed payments. And your fixed payments are your debt service, and your rent, your lease payments, call them lease payments, and your capital expenditures, CapEx. What is CapEx? CapEx is short for capital expenditure, which is equal to your spending on property, plant, and equipment. And you know the formula for that. It's ending net fixed assets minus beginning net fixed assets plus your depreciation expense. This is a fixed cost for the company. You've got to spend money on property, plant, and equipment. So what are we trying to do? We are trying to establish or ascertain how liquid a company is. Do they generate enough cash flow to pay all their fixed payments? That's what we're trying to measure here. Okay? Lastly, debt to EBITDA. Okay? So this is total liabilities divided by EBITDA or NOPAT. What are we trying to do here? We're creating a ratio. These really are more liquidity ratios, this and this. This is a leverage ratio. How does our debt compare to our cash flow? Okay? That's what these things are. So what we're doing is creating measures that allow us to compare how the company, do a trend analysis. How has the company done over time with these ratios? And how does the company look compared to other companies in terms of these same ratios? Okay? So we can make some judgments about how leveraged up the company is and how liquid the company is in terms of their ability to meet their obligations. Okay, we're going to take a quick break. I'm going to call my daughter back, and then we will run some numbers. We'll actually do some numbers, which is the last section, the worksheet section. We'll actually run some of these ratios. All right, peace out, shalom for just a second.